When you pick up a mutual funds, consider the expense ratio. One rookie mistake in choosing a mutual fund is neglecting to pay attention to the impact of fees on total returns, or which experts call the expense ratio. The fees vary from fund to fund and company to company. They also differ whether you choose a passive fund or an actively managed fund. A passive fund is one that approximates the growth of an index, such as Standard & Poor's 500 index of large companies. There are many index funds you can invest in. An actively managed fund is one that aggressively targets market-beating performance and is normally more expensive. Don't be fooled into thinking that compared to other fees like those of credit cards, your mutual fund fees, as a percentage of total investments, are low. What you might not realize is this: the fees that you will pay can eat up to your total returns in the long run. Take a look at this. Say you have $50,000 in a fund that delivered a 5% annual return. Offhand, after 30 years, you'd probably be very satisfied. However, if you look at the fund's expense ratio, you might become mortified instead of happy. In case the expense ratio is equal to 0.25%, the total fund expenses is $14,914. In case the expense ratio is equal to 0.5%, the total fund expenses is $28,831. In case the expense ratio is equal to 1%, the total fund expenses is $53,927. If you want to avoid paying hefty fees on your mutual fund, you can invest in passive funds because they generally charge lower fees. Many of them tend to produce better returns, so they are most appealing to many investors. Digging deeper, you can surmise a lot by looking at a fund's expense ratio. You can get a very good inkling of what kind of company manages the fund by looking at the expense ratio. It could be a greedy financial service firm whose main agenda is to earn from you by dangling whatever is trending in the market at the moment. Or it could be a company that is seriously willing to help you achieve your financial objectives through a long-term partnership. The latter kind will normally charge fewer fees. For what it's worth, the way a fund company treats its customers reflects its culture of dealing with their own employees. Fund managers can always leave their companies at any time, regardless of whether their portfolios have matured or not. So, if they receive some ill treatment from their employer, they can quickly leave the company and go to another investment firm. This puts you at a disadvantage because, unlike the fund managers, you can't just withdraw your money and transfer it to another company. That's it for now. On our website, you can find more posts as well as calculators and other financial tools. Considering a mutual fund investment? We would love to know your thoughts, so feel free to share them on the comments below. I hope you enjoyed it, and don't forget to subscribe to our channel on YouTube to get more free financial educative videos.